Hi guys, in this video today I want to talk about how to actually construct a client's brief or how to construct a brief for yourself. And this step is actually very important in research and analysis and trying to find the best area. Primarily because we all have different financial circumstances, we all have different investment goals, we all have different asset hold timeframes, i.e. how long are we going to hold the asset in the portfolio. And because of this nuanced difference, it will affect the areas that are actually suited for investing. Not every area is suited for everyone. A hotspot for me is not a hotspot for you, as I always say. You can have a budget of 850K and you can invest in certain areas where another person might have a budget of 550. So the area that you prefer has no use for a client that has a lower budget. Therefore, in the research process or trying to find the best suburb, or what I usually term as eliminating opportunity cost. And what opportunity cost means is essentially eliminating the cost of investing in a location that's not going to grow as much as all the other locations. The most important aspect of that process is determining your brief. And I want to show you in this video today how you can do that on HtAG. So we call this the goal matching process or the goal matching technique. And the easiest way to do that is to access our goal matching card on our dashboard. If you click on it, what you will see in this card, you will see multiple strategies, exactly 16 different strategies that fit 16 different variations of brief. And these strategies you will see are dynamic and will compress as you answer certain questions. So first, we have to determine what is our investment objective. Is it capital growth or cash flow? And this is very important. Okay, in property investing, we are after one or the other. Yes, there are balance strategies where you can invest in capital growth and cash flow areas, but usually this is cyclical. Areas move through capital growth cycles, then areas move through cycles where rents are more in demand. So essentially at the onset, you really need to determine what is the primary investment objective. Are you looking for capital growth to expand your equity base so you can leverage into additional purchases, or are you purely looking for cash flow properties where you can have 100 or 50 positive cash flow a week so you can stack your assets that way? Now, another session needs to be had as to what is the quickest way to get to a larger portfolio base, and my argument is that it's obviously the capital growth way, but again, different people, different circumstances. So the first question that you answer is whether you want capital growth or cash flow. Let's assume that we want capital growth. You can already see that from 16 strategies, we have actually eliminated one, and now there are 15 left. The next thing that we do is obviously what is our budget, and usually this comes down to how much you've been pre-approved or how much I understand you are willing to spend. Now, the reason why the budget is separated into different domains is because, or different segments, for example, 100K to 550, then 550 to 850 and 850 plus, is because each of these price segments actually produces a different set of indicators and metrics that are related to it to increase precision. Okay, now once you set the budget, obviously you can tinker with the budget a bit further and reduce it. That means that if you select, for example, 550 to 850, once you go to a separate page, which I'll do in the next video, and you partially might see it in this as well, you can adjust the budget range. And if you have only 750 to spend, you can make it from 550 to 750. Usually you put a 200K disparity in your budget just to cast a wider net and to increase the number of potential options you will get. But the most important thing is that these ranges have been developed because these ranges inadvertently imply or inform the primacy or the significance of different property investment indicators, which will increase the accuracy of your output. So that's a very important thing. The next thing that we do is we need to determine how long we want to hold the asset in our portfolio. Do we want to hold it long-term, 7 years plus, 10 years plus, and why? Do we want to hold it mid-term, which is 4 to 6 years, and why? Do we want to hold it short-term, 1 to 3 years, and why? Some examples could be, if you want to hold the asset 1 to 3 years, you might just want to hold the asset, leverage the upside of the area, sell off, absorb the sales and acquisition costs, but ensure you invest in an area that's going to generate substantial returns, and then you use those proceeds to enlarge your capital base so you can form a bigger asset. It could be one of the reasons, but there are multiple reasons. For example, if you want to hold it midterm, you might want to hold the asset for 5 years, generate as much equity as you can, sell it, pay down your PPOR. If you want to hold it 7 years plus or long term, you want to be in a position where you can refinance that asset, leverage the growth and refinance that asset a couple of times, once or twice, to leverage into additional purchases. But the most important aspect of this is that the time frame that you choose, again, also affects what property investment indicators are important. And this is essential because those property investment indicators will allow you to pick the best possible area for the for the time frame you're planning to hold the asset for. Okay, so let's say hypothetically we choose long term. And then question number 4 is, what is your equity extraction time frame? Now, equity extraction time frame is just another way of saying delineating a market heat indicator, or also talking about growth targets. So for example, there are a couple of options here that you can choose from: 2 years, 3 years, or 4 years. So inadvertently, what you're saying is, okay, if it's 2 years, I want the area to generate 20% plus return in the next 2 years so I can leverage into additional assets fast and build my portfolio fast, serviceability permitting, of course. If it's 3 years, I want to generate 20% plus in 3 years so I can leverage into additional assets. If it's 4 years, I want to generate 20% plus in 4 years so I can leverage into additional assets. Now, care must be taken when you're choosing the time frame, not only because that delineates the areas that you invest into, but the time frames come with its pros and cons. If you want to generate 20% plus return in the next 2 years, that means you inadvertently have to be investing in current hotspots. Now, if you're investing in current hotspots, the positives of that is that you will get the returns that you need, but the negatives of that are that you might find it difficult to source an asset because the competition is great within those areas, which is what makes them hotspots. Now, if you're investing in areas that will generate 20% in the next 3 years, this is what I call transitioning areas, or areas that are transitioning between warm spots and hot spots. As I mentioned before, they will generate about 20% growth in the next 3 years. They already started seeing some market momentum, have probably generated about 5% growth in the last year, which will make it easier for you to source an asset. The area has already started moving. However, you will need to wait 3 years to realize substantial gains to leverage into additional assets. And my favorite is the actual 4 year. 4 year means you're anticipating market movements. You're entering markets early. Yes, you'll wait longer for that market to gain momentum, but you will not have an issue with listings. Finding the listings, finding the right asset. You will enter into an asset before everyone else. You just sit on the sidelines, wait for the growth to occur. You realize your gains, you leverage into additional purchases, etc. Now, as you see, this all depends on what you're trying to achieve and what your brief is. And by answering all of these questions, you can see how the strategies actually compress and you are actually fitted to a particular strategy. And that particular strategy informs a particular set of metrics or property investment indicators that are important to find the best possible area, or the area that has the least opportunity cost, which I'll explain in the second video. All you need to do, for example, is click on the 4 years, you see you're matched with a particular strategy, and then you run the research algorithm, which takes you to the next phase. The next phase is the shortlisting, and this is what I will explain in the subsequent video. Take care, guys. I hope this has helped.